Okay, let's start with Chapter 1, Accounting and Business. First, we're going to explain the purpose and the importance of accounting. What is accounting? Well, accounting is two things. One, it's the language of business, and it's an information system that measures, an information and measurement system that provides reports to users about economic activities and the condition of a business. And then we'll also see that it's an information and a measurement system. And as such, it provides information to users about the business's economic activities and about its general financial condition. Now, as we said, accounting is the language of business. Okay, all organizations set up an accounting information system to communicate information and data to help people make better decisions. Okay, it can serve many users. It can be divided into two basic groups: external users and internal users. External users like lenders, creditors, shareholders, governmental agencies, consumer groups, customers, external auditors, and internal users of information would be officers of the corporation, managers of the business, internal auditors, and then any employee that works for the business, such as sales staff, budget officers, controllers, and any other employee. Now, financial accounting can be broken down into two, I'd say, primary functions, for lack of a better way to explain it. First, there's financial accounting, and financial accounting provides information to external users, again, like creditors, stockholders, governmental agencies. These users need data. Financial accounting provides data that judges past financial performance. So basically, what we're saying is, when we're practicing financial accounting, we're looking at information or data that's already happened. It's historical. Okay, it's already happened. So since it's already happened, it better be accurate. It better be precise. And it also needs to be objective and verifiable. What do we mean by objective? Free of bias. What do we mean by verifiable? It's got to be proven. That's right. It's got to be able. We have to be able to prove the data is accurate or true to a third party. Now, the data in financial accounting deals with the entire organization. So we're looking at financial information for the entire business itself. You're going to learn that financial accounting must follow what we call GAAP, Generally Accepted Accounting Principles, and we're going to talk about that in a little bit. And there are mandatory financial statements that must be prepared. Managerial accounting, the other major area of accounting, it provides information to internal users, those people who direct and control the business's operations. Now, that data needs to be enable the managers to run the organization. They're looking for data needed to run the organization. They're also looking at a future time frame. They're trying to look into the future. The emphasis is on the future. When we're creating a budget, we're looking into the future. Financial forecast, we're looking into the future. So it hasn't already happened. Okay, so since it's already happened, it's got to be relevant for the decision at hand, and it's got to be timely, but without so much, it's not going to be precise, because we don't know what's going to happen a minute from now, let alone what's going to happen a month, 2 months, or a year from now, which budgets and financial projections look at. When we're dealing in managerial accounting, we're looking at what we call segment reporting. So instead of looking at the entire organization, we're looking at different segments of the business. And a segment can be any area of the business that we need information on. It could be a store. It could be a department. It could be a product item. All right, so for instance, we could look at the 7-Eleven on Date Palm in Cathedral City. Or a segment could be all the 7-Elevens in Cathedral City, or all the 7-Elevens in the Coachella Valley, or all the 7-Elevens in Southern California. Those would be segments. Or we could look just at Slurpee sales. All right, Slurpee sales in the Cathedral City 7-Eleven. That would be a segment. All right, when we're practicing financial accounting, we don't necessarily need to follow generally accepted accounting principles because we can create the information however we best need it. Okay, there's no guidelines there, and there's no mandatory reporting. So it's different. Financial accounting, again, financial accounting. We're looking historical. It's already happened. It should be precise. It's got to be verifiable. It's got to be objective. It's got to follow GAAP. Managerial accounting, we're looking into the future. It's not going to be precise, but it's got to be timely for the decision at hand. It's got to be relevant pertaining to the decision at hand. No mandatory reporting requirements, and it doesn't have to follow any type of accounting policy principles. Now, there's a lot of opportunities for accountants. Again, some people practice financial accounting, some people practice managerial accounting, some go into taxation, some go into other accounting related industries. What I want you guys to know is when you go into accounting, you really don't practice any one area. Let's say you become a CPA, and CPAs, you're a certified public accountant, and basically they work for businesses. They work out. They don't work. They're not an employee of the business, but they will do the accounting for a business. Generally, small businesses will hire them. Individuals will hire them to do their tax returns, things like that. So a CPA, they'll do some financial accounting. They'll do some financial accounting. Okay, and so they can maybe prepare financial statements, analyze those financial statements. Maybe they do a little bit of auditing, some regulatory work, government compliance with the Security and Exchange Commission. They might do some consulting, tax planning. Now, notice I've talked a little bit about tax. So they do a little bit of this tax preparation, tax planning, tax investigation, consulting, managerial accounting, accountants, general accounting, cost accounting, budgeting, and so forth. Now let's talk about accounting as a measurement and information system. As an information and measurement system, we identify, record, and communicate. Okay, that's what accounting is. Identify, recording, and communicate. We identify selected transactions and events that take place. We record. We input, measure, and log these transactions. We keep a chronological listing of those transactions. And then we communicate that information by preparing financial statements. Again, accounting is a system that identifies, records, and communicates information, and that information needs to be relevant, reliable, and comparable about an organization's activities. Relevant, it's got to affect a decision at hand. Reliable, it's got to be trustworthy. We have to be able to count on it. And comparable, that information either we can compare to ourselves, like this year over last year, or we can use that information to compare our business to other businesses in the same industry. Now we need to talk a little bit about ethics and why it's crucial to accounting. There are morals. Morals are generally somebody's personal beliefs that distinguish right from wrong. And there's ethics. Ethics are acceptable standards of good and bad behavior. And accountants must behave to a very high standard of behavior. There's a couple of reasons for this. One, they're privy to a variety of private and often sensitive information. People take their tax returns to an accountant. They want to have trust that that accountant is going to keep that information private. You do accounting for a business. The business wants to trust you're going to keep that information private. And then the information has to be trustworthy. It's got to be free of bias. It doesn't matter if what the accountant thinks the numbers should be. They have to report the actual information. And that makes it much more useful for decision making. Now, sometimes people commit fraud. Fraud's it's the intent to defeat the internal controls of the business. Fraud is an intent to either steal or cheat the business. The fraud triangle tells us that we have three things that we need to create fraud. One, there has to be some kind of financial pressure, okay, like unpaid bills or something like that. Two, there has to be an opportunity. Okay, the person has to be able to envision a way to commit the fraud and perceive that there is a low risk of getting caught. And three, rationalization. The perpetrator fails to see the criminal nature of the fraud and can justify their actions. Now you ask, who's going to commit fraud? Well, just look around the room. It could be you or I. And then I'll tell my story. So the goal of accounting is to provide useful information, and it has to be trusted. So when an employee comes up to an ethical concern, they have to identify that ethical concern, use their personal beliefs are right or wrong, analyze their options, consider all the good consequences and bad consequences, and then make the best option after weighing all the consequences. Back in the early 2000s, the Congress passed an act called Sarbanes-Oxley, or SOX as it's called, to help curb financial abuses at companies that issue their stock to the publicly traded companies, and we'll talk about that a little bit more. SOX requires that these public companies to apply both accounting oversight, so they need more oversight, and stringent internal controls. That what they're trying to do is improve transparency, accountability, and truthfulness in financial reporting. And the reason is because of companies like Enron and WorldCom and Adelphia and Xerox and Bristol Myers, they've abused the financial system. You know, to look at all of these guys, they all inflated income. They all inflated income. And then just recently, Dodd-Frank Wall Street Reform Act and Consumer Protection Act was enacted by Congress. They wanted to, again, promote more accountability and transparency in the financial system. They put an end to that too big to fail notion. I don't know if you guys, but some of the banks back in the 2007-8, because of their questionable lending practices, they were in deep financial trouble. The government stepped in and bailed them out. General Motors too, that's another one. Okay, that can't happen anymore. They want to protect the taxpayers by ending out those bailouts. And they also want to protect consumers from abusive financial services. All right. So let's see. Let's classify the following activities as either identifying, recording, or communicating. Determining the revenue generated from a product. Keeping a log of service costs.